On December 17th, 2024, BlackRock did something that should have stopped the market cold. Not metaphorically, mechanically. Buried deep inside their year-end tactical outlook was a single positioning decision that almost nobody talked about. Not on CNBC, not on social media, not in the places where retail investors go to feel informed. BlackRock went short the S&P 500. Not cautious, not neutral, short. You were told the rally was healthy. You were told the election removed uncertainty. You were told American equities were the safest place in the world to be. That story is wrong. Not because markets are emotional, because the math doesn't support it. Here's the part nobody realized. BlackRock is not a hedge fund with opinions. It is the largest asset allocator on the planet, managing over $11 trillion, more capital than the GDP of Japan, more leverage over global flows than most central banks. When BlackRock publishes a tactical outlook, it is not commentary. It is a disclosure. And in December 2024, that disclosure said something extremely specific. They position to profit if U.S. stocks fall. Let me show you. To understand why this matters, you need to understand what BlackRock represents. This isn't a talking head guessing where markets go next quarter. This is an institution that sees global positioning data in real time, that tracks capital flows across pensions, sovereign wealth funds, insurance pools, and retirement systems. Most investors never see. They don't predict markets. They react to structure. And the structure they saw going into 2025 was dangerously familiar. In the weeks following the November election, money flooded into U.S. equities at a pace rarely seen outside late-cycle manias. Equity inflows surged. International exposure collapsed. Retail investors piled into the S&P 500, the NASDAQ, mega-cap tech, convinced that policy optimism justified higher prices, higher multiples, higher risk. This wasn't diversification. It was crowding. Think about that for a moment. When everyone is positioned on the same side of the trade, the market becomes fragile, not strong, because strength requires balance. Crowding removes it. BlackRock saw this clearly. Their own data showed what they called consensus overweight positioning in U.S. equities, meaning too much capital chasing the same outcome with too little margin for disappointment. And disappointment is the only thing markets can't price in once optimism peaks. This already happened before. In 1987, the stock market surged more than 40% in the months leading into October. Valuations stretched beyond historical norms. Investors believed structural innovation had made crashes obsolete. Portfolio insurance, computerized trading, risk management systems sound familiar? Back then, confidence was not emotional. It was mathematical. Investors believed systems would protect them. They were wrong. On October 19, 1987, the Dow Jones fell more than 22% in a single day, not because fundamentals changed overnight, but because positioning collapsed all at once. That is the parallel BlackRock is pointing to now. Not sentiment, structure. Here's the hidden mechanism. Markets don't fall when news is bad. They fall when expectations are too good. Going into January 2025, expectations for earnings growth reached levels that assume perfection. Analysts projected double-digit year-over-year growth, the highest since the post-pandemic rebound. At the same time, companies themselves were issuing warnings. Dozens of S&P 500 firms guided earnings lower. Negative guidance outpaced positive guidance by more than 2-to-1. That gap matters, because it means Wall Street promised more than corporate reality can deliver. This is the doom mechanism. When valuations price in perfection and reality delivers good but not great, markets don't hold steady. They reprice. And repricing is not gradual when positioning is crowded. This is where January becomes critical. Between mid-January and the end of the month, nearly the entire S&P 500 reports earnings. Not over months, over days. There is no time for adjustment, no breathing room. If the first wave disappoints, selling feeds on itself, algorithms trigger, options hedges unwind, liquidity thins. This already happened before. In 1987, the systems designed to protect investors accelerated the collapse. Portfolio insurance didn't stop losses, it multiplied them. Today, the architecture is different, but the logic is identical. Instead of portfolio insurance, we have delta hedging. Instead of program trading, we have high-frequency algorithms. Instead of specialists slowing markets down, we have automated execution that doesn't pause to think. BlackRock understands this. That's why their move matters. They didn't short the market months early. They waited until positioning was extreme and catalysts were close. That tells you something. This isn't a guess. It's a timing signal. The clock starts now. January 2025 is not just another earnings season. It is a compression window where expectations, valuations, and positioning collide. And when collisions happen in crowded markets, outcomes are not negotiated. They are forced. You were told this rally was different. You were told systems are smarter now. You were told risk is managed. That's exactly what investors believed in 1987. The difference today is scale, more leverage, more automation, more correlation, which means when the move comes, it doesn't ask permission. BlackRock isn't warning you with words. They're warning you with positioning. And history tells us that when the largest allocator in the world quietly steps to the other side of the boat, it's not because they're nervous. It's because they know exactly how easily it can tip. This is the signal. In January is where it gets tested. To understand why this signal matters, you have to stop thinking like an investor and start thinking like a system. Systems don't panic. They rebalance. Here's the part. Nobody realized. BlackRock didn't move because something broke. They moved because something became too perfect. In late 2024, capital flows into U.S. equities reached levels that only appear at the end of cycles. Not because growth is accelerating, but because belief is. Retail money poured into index funds, mega-cap tech, and momentum trades with one assumption baked in. Earnings will justify the price, and policy will remove friction. That assumption is the trap. Think about that for a moment. Markets don't collapse when expectations are low. They collapse when expectations are unanimous. By December, the S&P 500 was trading at a forward price-to-earnings ratio north of 22, far above its long-term average, a level that mathematically assumes earnings growth arrives cleanly, on time, and without disruption. History says that almost never happens. This already happened before. In 1987, valuations were stretched. Confidence was absolute. Risk models said drawdowns were manageable. Then reality arrived faster than models could react. Here's the modern equivalent. Today's market is not just crowded, it is synchronized. Correlations across asset classes have risen sharply, meaning stocks no longer move independently. When one falls, others follow. Diversification weakens. BlackRock's own commentary highlights this directly. When portfolios rely on the same assets for returns, the system becomes brittle, not resilient. That brittleness is what they're trading. Now look at the earnings setup. Analysts are projecting double-digit growth for the fourth quarter, the strongest year-over-year expansion since the post-pandemic rebound. On paper, that sounds optimistic, but corporate guidance tells a different story. More than 70 S&P 500 companies issued negative earnings guidance going into January. Less than half that number issued positive guidance. That imbalance matters, because companies don't guide lower casually. CFOs resist it. Boards fear it. They only do it when the alternative is worse. This creates a divergence between promise and probability. Wall Street priced in the promise. Reality is leaning toward probability. This is the doom mechanism. When earnings come in merely good, valuations must compress. When valuations compress in a crowded market, selling accelerates. Let's do the math. At a forward multiple above 22, even a small earnings miss forces repricing. A move back toward the long-term average implies a market decline that happens quickly, not gradually. An 8 to 12% correction doesn't require a crisis. It only requires disappointment. And disappointment is exactly what January tests. Between mid-January and the end of the month, nearly every major U.S. corporation reports earnings within a narrow window. There is no time buffer. If banks disappoint, financials drop. If tech disappoints, indexes fall. If guidance weakens, algorithms react immediately. This is where structure matters more than sentiment. Selling today is not manual. It's automatic. Risk thresholds trigger. Volatility spikes. Options dealers hedge by selling underlying shares. This feedback loop feeds itself. This already happened before. In 1987, portfolio insurance was designed to reduce risk. Instead, it amplified it. Today, delta hedging and algorithmic execution serve the same function. They don't ask why prices fall. They just respond. BlackRock understands this architecture intimately. That's why they didn't short impulsively. They waited for the setup. Crowded positioning, elevated valuations, compressed earnings window, then they acted. This is where the shame loop tightens. You were told the rally was justified. You were told valuation didn't matter anymore. You were told passive flows make markets safer. But the very tools designed to stabilize markets now make them faster. Faster down, faster through support, faster than reaction time. This is not fear, it's mechanics. And mechanics don't negotiate. BlackRock is not betting on disaster. They're betting on asymmetry. Limited upside, significant downside, compressed time. That's a trade institutions make when probability tilts, not when headlines scream. January is the test. Not because something new will happen, but because something already priced in may fail to appear. And when that happens, the market doesn't ask who's right. It reprices. Quietly at first, then all at once. This is the part of the cycle where the crowd realizes too late that optimism was the risk. BlackRock already moved. The question isn't whether volatility arrives. It's whether you understand why it will. Because this exact setup has a name in history, and it never ends gently. What makes January 2025 dangerous is not bad news. It's speed. Speed turns adjustment into damage. Here's the part nobody realized. Modern markets don't fall because investors change their minds. They fall because systems are forced to act faster than humans can respond. That is the real parallel to 1987. Back then, portfolio insurance was supposed to limit losses. Instead, it created a mechanical death spiral. Prices fell. Programs sold. Selling pushed prices lower. More programs sold. By the time anyone understood what was happening, the Dow was down more than 22% in a single day. This already happened before, and the architecture today is more fragile, not less. Instead of portfolio insurance, we now have options-driven markets where dealers must constantly hedge exposure. Instead of manual execution, we have algorithms executing thousands of trades per second. Instead of diversified portfolios, we have index concentration where a handful of stocks drive entire markets. Think about that for a moment. When volatility rises, options dealers hedge by selling the underlying stocks. That selling pushes prices lower. Lower prices increase volatility. Higher volatility forces more hedging. This is not panic, it's math. This is the doom mechanism BlackRock is positioning for. Now add the earnings compression. Nearly the entire S&P 500 reports earnings within an 18-day window. That removes time, which removes judgment. In a normal environment, disappointing earnings are absorbed gradually. Analysts revise models. Investors rebalance over weeks. January doesn't allow that. If the first wave disappoints, selling begins immediately before later reports arrive. There is no pause, no recalibration. The market reprices in real time. This is why timing matters. BlackRock didn't short in September. They didn't short in October. They waited until December when positioning was extreme and catalysts were close. That is not fear, that is precision. Here's where the historical echo becomes unavoidable. In October 1987, investors believed systems had eliminated crashes. Portfolio insurance was supposed to provide liquidity when prices fell. Instead, it removed it. Today, investors believe liquidity is infinite because of ETFs, options markets, and algorithmic trading. But liquidity only exists when both sides are willing to trade. When everyone is positioned the same way, liquidity disappears instantly. This is the hidden agenda of crowding. It works until it doesn't. Now look at correlation. When assets move together, diversification fails. Stocks, bonds, and derivatives respond to the same signals. BlackRock explicitly warned about this. When correlations rise, small shocks produce large outcomes. That's not speculation, it's system behavior. This is why the earnings window is critical. Disappointment doesn't need to be dramatic, it just needs to be widespread. If banks report weaker margins, if tech guides conservatively, if costs rise faster than revenues, that's enough. Because at current valuations, perfection is already priced in. Anything less forces repricing. And repricing in a crowded, automated market is not orderly. It cascades. This is where the shame loop tightens further. You were told passive investing reduces risk. You were told indexes are safer than individual stocks. You were told volatility is lower now. But passive flows don't remove risk. They concentrate it. When indexes fall, everything tied to them falls too. There is no selective selling, only mechanical liquidation. This is exactly what happened in 1987. And it's exactly why BlackRock is positioned now. They are not predicting a crash headline. They are trading the probability that systems amplify disappointment faster than humans can adapt. That probability rises sharply in January. This is the ticking clock. Once earnings begin, there is no rewind, no pause button. If the first domino falls, the rest don't ask why. They fall because the structure demands it. You were told markets are forward-looking. That's true, but they are also unforgiving. When expectations outrun reality, the adjustment is swift. BlackRock is not standing in the crowd hoping for a soft landing. They stepped aside. They took the other side of the trade. Not because they enjoy being contrarian, but because history shows that when structure, valuation, and timing align, outcomes repeat. 1987 was not an accident. It was a mechanism. And mechanisms don't care what year it is. January 2025 is not guaranteed to crash, but it is guaranteed to test the system. BlackRock already decided how that test is likely to end. The only question left is whether you recognize the setup before the market forces everyone to recognize it at once. Every cycle ends the same way, not with a warning, with a realization. This is where January 25 moves from theory to consequence. Here's the part nobody wants to say out loud. If BlackRock is wrong, nothing breaks. If BlackRock is right, everything moves at once. That asymmetry tells you everything about why this trade exists. Institutions don't position for drama, they position for probability. And the probability BlackRock is trading is not a crash narrative. It's a structural repricing event driven by disappointment, compression, and forced execution. This already happened before. In 1987, the crash wasn't caused by bad earnings. It wasn't caused by a recession. It was caused by positioning colliding with reality faster than systems could absorb it. The same condition exists now. Valuations assume clean growth. Flows assume continued optimism. Risk models assume liquidity. January challenges all three at the same time. Think about that for a moment. When expectations are high, markets don't need bad news to fall. They just need news that isn't good enough. That's the trap. This is why BlackRock's timing matters more than their words. They didn't publish a warning headline. They adjusted exposure. They reduced long positions. They went short U.S. equities. They shorted long duration treasuries. Those are not casual moves. They're coordinated. Together, they signal stress, not confidence. Here's the hidden agenda. If markets fall, central banks will respond, liquidity facilities will expand, narratives will shift. That's normal. But the first move happens before intervention, and that first move is where most damage occurs. Retail investors don't trade in advance of catalysts. They react after them. By the time selling feels obvious, prices have already moved. This is the institutional advantage. BlackRock can hedge, they can rotate, they can cover. Most investors can't. They are fully exposed through index funds, retirement accounts, and passive allocations that don't allow rapid adjustment. This is where the personal stakes become unavoidable. If you are heavily allocated to U.S. equities, you are implicitly betting that earnings exceed expectations, that guidance improves, and that volatility remains contained. That's not a neutral position, that's an aggressive one. You are betting against the largest asset manager in the world. Maybe you're right. Maybe this time is different, but history is not on that side of the trade. This already happened before. In 1987, professional traders reduced exposure before October. They covered after the crash. Retail investors did the opposite. They stayed in because they didn't want to miss gains. They sold after losses became unbearable. By the time markets recovered, many never re-entered. The damage wasn't permanent loss of capital. It was loss of positioning. That's the real cost. Here's the final mechanism. Once selling begins, markets don't wait for consensus. Algorithms don't pause for interpretation. Options hedging doesn't ask if the move makes sense. Everything reacts instantly. That's why January matters. It compresses uncertainty into days. It removes delay. It forces outcomes. BlackRock understands that. They don't need a 1987-style crash to be right. They just need volatility to spike and valuations to reset. Even a 10 to 15% repricing is enough. And in a crowded market, that move can happen faster than most people believe possible. This is the final echo. You were told the rally was healthy. You were told valuations don't matter anymore. You were told systems are safer now. That's exactly what investors believed in every late cycle market. The tools change. The logic doesn't. BlackRock didn't signal January 2025 because they enjoy historical analogies. They did it because the structure lines up. Crowding, valuation, catalyst, mechanism. That combination has a record, and it's not a good one. So return to the beginning. On December 17th, 2024, BlackRock made a move that most people ignored. Not because it was hidden, but because it didn't come with noise. That's how real signals work. They don't ask for attention, they wait for confirmation. January is when confirmation arrives. And by the time the market agrees on what's happening, the trade will already be over. That's how it happened in 1987, and that's why BlackRock moved first this time too.